Do you ever feel like when it comes to your retirement plan, you're completely out of control? One day you turn on the news and things are great. The next, things are terrible. Then someone starts a trade war. You have no control over anything. How are you going to deal with that? How are you going to even plan for it? Welcome to the modern retirement planning dilemma. It used to be in the good old days, you could get 8% on a bond and live happily off it. Now, the government has seen to it that that's not possible. At least not with any reasonable bond. So what do? You use the old strategy and buy bonds and try and live off the interest? You're going to lose to inflation. Time and time again, the longer you go, the less purchasing power you're going to have. Or do you do the opposite and put all your money into stocks? What happens if another event like 2008 happens and the market loses almost 60% of its value in a very short period of time? Can you handle that? I don't know many people who can afford to take that level of risk and not seriously affect their lifestyle. What I want to show you today is that there's a way to get both the benefits of fixed rate investments as well as the benefits of the higher risk equity markets. So if you're someone who's in retirement or nearing retirement and you're concerned that the way the world is heading might lead to your investments losing too much value and affecting your lifestyle, then this video is for you. With that said, let me be clear. This is not a sales pitch for an annuity or an insurance product or a get-rich-quick scheme. This is talking about investment strategies that have worked, that are simple, that are effective, and that are flexible. Hi, I'm Alex Pars, one of the founders of Ironwood Financial here in Tucson, Arizona. I've been doing this for almost 20 years, and I've learned that people want and need two things in retirement. First, they want a good enough return to cover their expenses and cover inflation. And they need an investment strategy that minimizes losses and makes sure they're not wiped out in the next Great Recession. Accomplishing these two things is crucial to having a successful retirement. There are two things you need to know. You need to know what exactly is your strategy, and you need to know what you're going to do in the next market downturn before it happens. If you don't know the answers to those questions, you're going to be in real trouble the next time the market takes a big downturn. You may not be able to pay for that next vacation. You may not be able to help the grandkids with their college education. There are many things that you may not be able to do if you don't properly protect yourself with knowledge in advance. So let me just say, you're not alone. There are people who come into our office that we meet every day who share the same concerns that you do about making sure that they can have the best retirement possible and not worry about running out of money. And I'm here to show you that Ironwood Financial can help you create an efficient and effective strategy to make sure that you approach your retirement the right way. So let's talk about the dangers of investing first in all stocks. If you put your money in the S&P 500 in 2000, by 2002, you would have lost almost half of it. Okay? You would have recovered eventually, but then in 2008, you would have lost more than half of it. And there's even worse times, like Black Monday, where the market dropped over 20% in one single day. Yet, over time, the stock market averages almost 10%. Well, relying on stocks is dangerous. I don't know very many people who could afford to take a 50% hit while they're in retirement and maintain their lifestyle. So let's talk about danger number 2, investing only in fixed investments. Well, as I said earlier, interest rates are really low. It's very difficult to find safe, fixed investments that pay enough to cover inflation. So, for example, if you're spending $50,000 a year on your lifestyle, in 20 years with a 3% inflation rate, that's a $90,000 lifestyle. You give it 30 years and we're up to $120,000. If you're not keeping up with inflation, you're not going to be able to keep up your lifestyle. You're not going to have the nice things that you like to have that you worked so long and so hard to provide for yourself and your family. Now you can see, because of what I said, the need for balance. We can't simply use one of these strategies. We have to use a combination because we need both the growth and the safety. So what are the common approaches we see that people are using to try to make sure their money lasts in retirements? The first approach we see is relying on the averages. As we talked about earlier, the stock market average is almost 10%. Well, if I'm taking 5% out per year and I'm making 10% average, no problem, right? Not so. The reason is because the market doesn't make 10% per year. It makes 10% average. There's a big difference. Use our example before, where we had a 50% drop in the market. Let's say you had $1 million and you're taking 50,000 out per year. Now the market drops 50%. Now you get 500,000 and you still want to take 50 grand out? That's unsustainable. If you look at the time period from 2000 to 2014, if you'd had $1 million and you took out $50,000 per year adjusted for inflation, you would have run out of money in only 14 years. And that's in an all-stock portfolio that supposedly has a long-term average of 10%. Why? Because of the volatility. We can't handle that when we're spending our money. The next common approach that we see all the time, and the thing that people think that advisors do, is time the market to try to beat it. Advisors supposedly know when to get in, when to get out, what classes to buy. That doesn't work. I don't know a single investor who's successful over the long term with market timing. I've seen people go boom, then bust so many times I can't even count. Even those few people who saw the 2008 Great Recession coming and got out of the markets, you know what they did? They didn't get back in. Okay, so while the market, it did fall quite a bit, but now it's more than double where it was before that crash happened. And they've been sitting on the sidelines in record low interest rates for almost a decade. They've lost money. They can no longer afford their lifestyle because of inflation and low interest rates. It just doesn't work for almost anyone. The next common approach we see all the time is annuities. I just got a call today from a client about someone who's promising the latest and greatest 6% annuity. We already did a video on these things. They're very misleading, and the reality is they're based on today's interest rates. If the bank is paying 1, if the Fed is paying 3, how can an insurance company who loves to build big fancy buildings pay you 6? They're not. It's smoke and mirrors. They're tying up your money for long periods of time at today's interest rates minus expenses. You're likely to get a rate of return of less than 2% per year over the rest of your life if you buy one of the annuities offered today. Remember what I said earlier about inflation? If you're getting less than 2% for the rest of your lifetime, your lifestyle is not going to keep up. Now, don't get me wrong, not all annuities are bad, and someday when interest rates are higher, they may be a great thing again. But for right now, I would strongly suggest you read them very carefully and get 2 opinions before you even consider buying one. Common approach number 4. Whenever you look at the internet, you're pretty much slapped in the face with the 4% rule. This is a rule that supposedly, through the worst markets, if you only take out 4%, you'll never run out of money, and it's time tested, it's proven, so on and so forth. Technically, that's true, but people do it wrong. If you don't pick the right funds, if you don't have specific rules that tell you what to do and when, then chances are you'll make a mistake. The rule is too simple. People are terrible at sitting on their hands in a crisis, and they make mistakes if they haven't planned it out in advance. So the point here is the 4% rule only works when you allocate your investments correctly and take the right actions and eliminate emotions. But time and time again, the horror stories that you hear are people who thought they followed the right plan, but because of bad planning or bad execution, their plan failed. Enough with what doesn't work. So now, the good news. The good news is that there is a strategy out there that's efficient, it's effective, at helping you get the long-term returns that you need while also protecting you against the short-term downturns that are inevitable in the stock market. And guess what? It's not fancy. It's not extravagant. It's not the new best thing. As an advisor, I always look for ways to simplify investing and make sure that my clients can maintain their lifestyle even in poor market conditions. And the big realization I had was that by dividing the portfolio into different goals and using tried and true principles investing, I could help create a strategy that our clients could use to invest successfully. You see, every day I see a new strategy being pushed, a new answer, whether it's a put strategy, an annuity, cryptocurrencies, advanced algorithms. It's been going on forever, as long as I can remember. But the answer is something you've most likely heard before. The problem is we are ruled by emotions. We're always looking for the new magic bullets. But investing successfully is not about the new magic bullets. The standards of investing successfully have not changed, period. The problem is people. Emotions get the better of us as we search for new strategies and fall prey to sales pitches that are based on promises and hype strategies, not on the core fundamentals that have never changed. And this is what led to the development of the Ironwood Approach, which is based on two key principles. Principle number 1, create guardrails for your emotions. This is the biggest mistake we see individual investors making. One of the best advantages to having an advisor is it helps you bounce things off when things get tough. I'm going to use an example here. The Fidelity Magellan Fund, one of the most legendary funds from 1977 to 1990, had an average return of 29% per year. But when Fidelity actually did a study to see how the investors in that fund actually fared, guess what? On average, they lost money. How do you do that? How do you lose money when the fund is averaging 29%? The answer is emotions, market timing, moving in and out of the investments at the wrong time based on feelings. Eliminate feelings, go with a strategy that makes sense. So how do you protect yourself? You protect yourself with the right plan. You need to know things like, what will you do in the next big market crash? What will you do when there's a big unexpected expense? This helps put guardrails on your emotions because your emotions get the better of you. You're deciding how you're going to act when you're level-headed and thinking logically. Principle number 2, segmenting your assets. Earlier, we talked about the perils of investing in all stocks and also the perils of investing in all bonds. So, how do we get the benefits of both without the downsides of either? How we do that is by segmenting our money into 3 separate piles. The first pile is money that you're going to spend in the next 5 years. What we do with that is we put it into something very safe, like CDs or short-term bonds. We spend that money down over 5 years, and what we've done is we've bought ourselves 5 years for the second pile of money to grow that we also funded at the same time we funded the first pile. This pile of money we didn't need to spend at all during those 5 years. We gave it a chance to weather market volatility and recover if there was a downturn. So that money we can invest a little more aggressively, hopefully get a little better rate of return. And then when year 6 happens, we push that money forward into safe investments and once again spend it down over 5 years. At the same time we funded those first 2 piles of money, we also fund a third pile of money. This is the money that we're going to be investing for the 10-year plus time horizon. Suddenly, it's like you're not even retired anymore. You can now have money that you're investing that you don't need to spend for 10 years. You can take so much more risk, you can weather so much more volatility, and you can hope to get closer to those long-term averages that we talked about earlier that the equity markets can provide. Once the 10 years have passed and that third pile of money hopefully has grown up, we simply start over. The great thing about this plan is it's very flexible. We're not going to lock up any money. We're not going to put you in anything with a surrender charge, hidden expenses, you name it. It's going to be vanilla, straightforward investments that have worked for the last 90 years. If there's a good year, guess what? we move money forward. So we make sure that we have another 5 years in case there's a market crash. If there's a bad year, well, we don't need to sell if the market's down because we provided for that. We've got a 5-year cushion to cover bad markets. So the chances of you ever having to sell at the wrong time are very low. We've been using this strategy through the tech bubble, through the Great Recession, and we're still using it. And we're not going to fall prey to the new shiny penny that everyone else is touting around as the best new thing. We're going to stick with the strategy that we know and trust through the future. So, in summary, a simple strategy eliminating emotion without gimmicks or fancy overpriced products is what we think it takes to succeed in retirement. That's what I've come to believe over time as a more realistic basis for proper retirement income planning and how you can protect yourself from bad markets. Not relying on fancy strategies like puts or calls that cost an arm and a leg, annuities with high fees, overhyped projected returns, or even the newest strategy that came out to beat the markets. Control your emotions, rely on history and time-tested strategies that have worked. That's what we believe in. And the benefits are strong for our clients and for people like you. They get to stay invested in the equity markets and create a portfolio designed for their unique situation. And with our support and guidance, they get help making the big decisions that make or break investing over time. And they get access to a model that protects them in the short term so they can stay invested over time and take advantage of the long-term average returns. So, who is this system for? Well, if you're close to retirement, or if you're in retirement now, or if you're simply sitting there saying, you know what, the last 10 years, my retirement account has grown in value a lot, and I'm not confident that I can make the right decisions when the market is misbehaving, then our system might be the right fit to keeping you invested in a portfolio designed to help you live your ideal life in retirement. If this sounds at all interesting to you, we are offering a free face-to-face review of your situation with me and my team right here in Tucson so you can have confidence that you're on the right track. In that meeting, we'll cover the risks that you face in your current portfolio. We'll discuss in detail how our system works, and we'll try and answer any questions you might have about mitigating risk and how you can invest for success. If, after that first meeting, we feel there are ways to help you, we'll actually get back together and go over our philosophy in more detail. We'll go over your situation. We'll run projections. We'll show you how your retirement plan is going to look in the future. We'll go through different strategies, the pros and cons of each. And then eventually, we'll say, here's what we would do if you were to hire us. Then we'll send you home to think about it. We don't want any high-pressure sales. We don't want anyone to make a decision that they're not comfortable and confident with. After that, we'll get back together, we'll answer questions, and if you want to proceed, we're happy to have you as a client. So go ahead, click the link below, schedule your free strategy session with me and my team. Again, I'm Alex Pars, one of the founders of Ironwood Financial. Thanks for taking the time to watch this video, and we look forward to talking to you soon.